Hello and welcome to 5-Year Club video number 101. The Simple Path to Wealth is the title of a book by a man named J.L. Collins. Don't actually know his name. Haven't actually personally read his blog that much. I've probably read a couple of articles over time, but I know that he is well known and well liked in the personal finance community, at least in the early retirement community. The Simple Path to Wealth, your roadmap to financial independence and a rich, free life. J.L. Collins, with foreword by Mr. Money Mustache. I certainly am a fan of Mr. Money Mustache. J.L. Collins has a blog. I'm going to link to that in the description. He also has a talk that he gave at Google that there's a video of that's about an hour long, and I would expect that he hits the high points of his advice in that video, so I'm going to leave a link to that in the description if you'd like to skip my video and cut to his meat. Well, that's kind of weird. Yeah, but you know, whatever works, however you can absorb this information, whether it's a book, whether it's an audiobook, whether it's a video, just get the information in you, and the more often you do it and the more times you do it, the more that you'll believe it, the more that you will feel its truth, and the better financially you're going to do. So yeah, I don't care what, you know, if it's a you know, I'm trying to think of a ridiculous way to communicate something, like a robot mouth that you have to feel with your hands. I don't know. Anyway, watch this video. I'll put a link in the description. The reason why this particular book interested me is because it is so short. It's only 286 pages. I've read several other investing books before this. All of them are longer than 286 pages. We've got The Little Book of Common Sense Investing by Jack Bogle, he's the founder of Vanguard Funds, and I love Vanguard Funds. That one's 304 pages, and that's probably the second book I'd recommend, both because of the length and because I believe the information is great. A Random Walk Down Wall Street, 496 pages. Stocks for the Long Run, 448 pages, and The Future for Investors, 336 pages. So The Simple Path to Wealth is the shortest of all these books, and it contains the same basic information. It is a little less technical than some of these other books. Not that these other books are all that technical. They certainly don't require a degree in finance. But The Simple Path to Wealth usually avoids extended discussions that involve, you know, investment return rates and fee percentages and things like that. And for sections where it does get into the nitty-gritty details, it is generally limited to a specific chapter, so you could skip that chapter if you want. J.L. Collins is not as funny as Mr. Money Mustache, but since Mr. Money Mustache does not have an investment book for me to recommend, then I can't recommend that. But Mr. Money Mustache does have a blog article on investing, which I'm just going to read now in full because I think it's so important for people to have this information. I don't want to talk about a book and then have you, you know, leave this video and it be a mystery. So let's just talk about investing. Mr. Money Mustache, this is, you know, from May 18th, 2011, so this information is not new. How to make money in the stock market. I must admit my title for this article sounds scandalous and scammy, like something a Las Vegas-based email spam company would send out. But it's also completely accurate because I really can teach you the best way to make money from the stock market all in one short blog post. Some of our readers are already advanced investors. Those few people already know all of this, and the article will just be preaching to the choir. But the reason I'm still writing is that almost nobody I meet in day-to-day life knows anything about investing, the stock market, or big publicly traded companies in general. Their opinions on the subject range throughout boredom, fear, mistrust, and if they are lucky, curiosity, or if they are unlucky, bold confidence in their abilities to drastically beat the market with their intuition. Here are 3 real quotes I have heard from friends over time when discussing the stock market. Stocks are just a big roulette wheel. You can't go out swimming with those sharks on Wall Street. They'll just eat you up. I don't know what my retirement money is in. I just checked some boxes on the sheet when I started my job, but I don't really understand it. This was me when I was 22. I picked something, didn't really understand it. I don't really believe in mutual funds at all. I'm dedicated enough to my own research, and I can pick winning individual stocks. I've got some Apple, some Google, some crude oil, gold, pig's feet, whatever. All 3 of these approaches are understandable but wrong. The sentiments are valid, and I'm glad that people at least have an opinion, but each represents a lack of knowledge about the statistics that run the whole system. Knowing the nature of the market is the key to being able to invest huge sums of your money over time with the absolute confidence that you're not doing anything stupid. It's worth gaining this confidence because investing knowledgeably in stocks has always been the single best thing to do with your money in terms of getting lifetime income with absolutely no effort on your part. To start with the basics, what is a stock? It's a slice of a company that you truly own. When you own a share, you have the right, but not the obligation, to attend the shareholders' meeting for that company, vote on important company decisions, and you have a right to a share of any future earnings that company makes. This share of earnings is called a dividend. In some companies, especially smaller or younger ones, the company elects, with the permission of its shareholders, to reinvest the dividends to help the company grow its earnings even faster. In theory, this means you will get more dividends in the future. Thus, the real value behind any share in the company is the right to get a never-ending stream of dividends from it. For example, the old, long profitable company Lockheed Martin currently pays a 3.8% annual dividend while growing slowly, while Apple Computer, fancying itself a high-growth company, pays 0% right now and reinvests all profits for faster growth. Why do stocks go up and down so much? The true value of a stock is based on the amount of dividends this stock will eventually pay you, the shareholder, over time. The dividend depends entirely on how much money the company will make, but nobody actually knows in advance how much money the companies will make. They just have a big host of differing opinions. Every day, millions of investors and analysts scurry around and worry about how much money each company will make in the future. The Libyan people are revolting. This will make the world have a shortage of oil, so prices will go up. Oil companies are now worth more. Buy. The U.S. economy is slowing down. This means people will drive less to the shopping mall and buy less gas. Oil demand will go down and oil companies will make less. Sell. It's a never-ending den like this for every single stock on every single stock exchange throughout the world. If stocks are so crazy, how can I make money off them? Because in the long run, it turns out that all of this speculation and volatility always cancels out to absolutely zero. The value of the stock will go up as the earnings of the underlying companies go up. A portion of the ongoing earnings will always flow to the shareholders as dividends, and all this happens because of the natural ingenuity of hardworking humans making things at a profit and continuing to advance our knowledge and technology and make us all more productive in every field. There may come a time when we can no longer advance, but based on the fact that we're still driving around in gas-burning tanks and Home Depot is still doing all of its computing on green-on-black mainframe computers that kick you back to the beginning of the order if you make a typing mistake, I'd say we still have at least a lifetime to go in this department. So, stocks go up and pay dividends over time, and they have since the beginning of modern commerce. The total return has averaged a very lumpy but fairly dependable 10% per year before inflation, 7% after inflation. 5 of the 7% comes in the form of rising stock price, and the other 2 comes from dividend payments directly from the company to you. When you're in your stashing stage, that would be the wealth accumulation phase, you just let these dividends automatically reinvest in more stocks, which creates a nice compounding effect. But which stocks do I want to buy to make this free money. But which stocks do I want to buy to make this free money? This is the easy part. You buy all of them. The world's smartest people have done incredible studies on this for over 40 years. What they find is that the best way to make money in the stock market is simply to buy an index fund, which is a mutual fund that automatically buys appropriate ratios of every major stock in your country's stock market, with no magic and no guessing of which stocks are better than others. The reason the index fund wins statistically is because it can be run by a simple automated set of rules. No need to pay $350 million salaries to the hotshot traders running the aggressive growth fund down the street. Because there are millions of people, both smart and dumb, squabbling over the value of each stock, the index fund benefits and suffers from all the individual stock performances. But overall, you get the average performance of all this squabbling. If you descend into the pit and try some squabbling yourself, you may come out ahead or drastically behind the average. But as it turns out, you can't predict in advance which squabblers, including yourself, will win and which will lose. All you can predict is that your average performance, if you buy enough of these funds, will be equal to the return of the market as a whole minus the amount of fees your mutual fund charges. So, by picking the index fund with the lowest fees, you automatically win. Endless statistical analysis proves this again and again. If you don't believe me, read the book A Random Walk Down Wall Street, which I mentioned earlier. Or look up the topic of John Bogleheads, and the foundation of the Vanguard company itself. And the first book, The Little Book of Investing, is a book by John Bogle. I guess I said Jack Bogle. I like calling him Jack Bogle for some reason. But my uncle bought some stock once and sold at a big profit. Also, if index funds really are statistically the best bet, why are there still thousands of brand name mutual funds and hotshot traders out there? For the same reason that Las Vegas still exists and people still drive SUVs. Humans are irrational creatures, and it is scientifically proven that we overestimate our own investment and gambling abilities, and no presentation of knowledge to the affected people can completely erase this. I have some perfectly intelligent friends who still believe they are lucky at games of chance, even though any scientist in the world can quickly run an experiment to irrefutably disprove the existence of any form of luck. The only tool you can truly use is statistical probability, and by buying the market average and lowering your investment costs, you are improving your statistical chances. Okay, fine. What index fund do I want? There is one king index fund that makes the decision easy for you. The Vanguard Total Stock Market Index Fund tracks the entire U.S. stock market. Its expense ratio is 0.17%. I think this has gone down since 2011. I think it's 0.04% now. This means that for every $100,000 of shares you hold, they subtract $170 per year from, and now I think it's more like $40 per year from their gains to pay for their offices and trading costs. Some funds charge 10 to 20 times higher fees. Literally, they do charge 10 to 20 times higher fees. So if you're looking over employer-sponsored plans, try to find a total stock index fund, or at least its close cousin, the S&P 500 index fund, and compare the expense ratio to 0.04, because that's the current number. What is the S&P 500? This is a collection of shares in the 500 largest companies in the US and therefore in most of the world. They are all multinational companies, so they benefit from growth around the world. If you really want to invest without having to worry, the S&P represents good odds. If you buy the stock market index of a smaller country like Canada, you will still have good odds, but at a higher volatility. During the dot-com boom of the 90s, a company called Nortel once represented 70% of Canada's entire stock market value. Holy moly. This company is now bankrupt, so you can imagine how that felt to investors solely in the Canadian index. Now Canada is the new Saudi Arabia with oil exports, so its index is again riding high on oil company stocks. I wouldn't bet my whole mustache on that one commodity either. What about international stocks? Some people like to get fancy and buy international index funds, which can do well when the US is hurting, as it has been recently. Remember, this is 2011 that this article was written. This is fine as long as you understand that it's just another form of trying to outsmart the basic stock index. When you do this, you are stating that you believe the stock markets of other countries are more undervalued relative to future growth than the U.S. market is. The U.S. is traditionally the most business-friendly country in the world, so its stock index has tended to have the highest performance after taking into account its lower risk and volatility compared to, say, throwing all your chips into Russia or China. It may or may not pay off in the future. I just want to point out that most people just make this decision on a whim. Something like China is so hot right now, they're taking over the world. Whereas to actually justify international investing rationally, you'd have to be a very sophisticated investor and truly understand why you are doing it. In the book The Future for Investors, Jeremy Siegel, the author, talks about demographic trends and why he believes that international stocks are a good bet over the next 50 years. That's just an FYI. Please go read the book yourself, The Future for Investors. So there you have it. In 2 words, Vanguard.com and VTSMX. In Canada, check out TD Waterhouse and their own series of funds, and let me know if you have any questions about what you find there. Mr. Money Mustache has a Canadian investment expert panel that can help us out. All right, so I guess that's Mr. Money Mustache is like on his forum. If you were investing in Canada, you would find that out. So in short, total stock market index fund from Vanguard. I believe there's one called VTSAX that has even lower fees if you can afford to invest $10,000 starting off. And if you want the exchange traded fund version, that is VTI. All right. All right. I don't agree with 100% of the stuff in The Simple Path to Wealth that J.L. Collins says. Specifically, where I differ from him is that I believe that people should pay attention to their feelings when they are thinking about what to do with money in the next year. And for me, the classic example is I chose to pay off my mortgage early. I had a 3.125% interest rate on that mortgage. Like we learned in that article we just saw, 3.125% is like the level of inflation. So in the long run, the stock market is going to average about 7% beyond that. It's probably going to be closer to 10%. So the math would indicate to me that I should have kept my mortgage at 3% interest and then invested the money, and I would have gotten 10% return on that over the long run, 7% real return. Why didn't Lewis do that? The reason why Lewis didn't do that is 2 reasons. Number 1 is I do not like Bank of America at all. If you don't already know, I hate Bank of America, and that's who my loan was with. Number 2, I really wanted that mortgage to be gone. I wanted to feel free. I didn't want the financial obligation of continuing to pay that mortgage. I didn't want the monthly cost. I didn't want to see that money coming out of my account every month. And finally, number 3, trying to decide which thing to say. Don't like Bank of America. Don't like fixed costs. And the final one is just like straight up, I knew that I disliked it so much that I would save more money and spend less money and sacrifice deeper just to get rid of it faster than if I had a different goal. Because that was a very motivating goal for me. And those things taken together, I said, like, you know what? If I'm going to save more money or I'm going to spend less money by choosing this goal instead of a different one, and that's emotionally true for me and that's going to keep me motivated for 12 months, then let's do this one. Because for me, that's the one that I'm fired up about. And I believe that people should consider as a piece of the puzzle what they're fired up about when they decide what to do with money. That doesn't mean that you don't consider math. So this doesn't mean like that I did not look at those numbers, about what the stock market would return in the long run versus what my investment interest rate, my mortgage interest rate was. I knew what the math was, but I also knew that like I could get rid of that mortgage and still have a substantial period of earning and investing and wealth building after that. And so even if mathematically I didn't make the optimal choice by paying it off, behaviorally, perhaps I did, because if I had picked a goal that was less motivating, perhaps even if I had invested it in the stock market, I would not have I wouldn't have just like saved more money, period, and learned how to sacrifice deeper. And so even though the return was better, the initial investment would have been smaller and I wouldn't have come out ahead. But even if that wasn't true, I knew that I was going to be fine in terms of being able to build up a big enough stock investment portfolio. Yeah. Whereas J.L. Collins, he's more on the side of force yourself to do the thing that's mathematically optimal. So if you're paying down debt, his opinion is to pay off the highest interest rate debt first, which is different from what, for example, Dave Ramsey recommends, which is to pay off the lowest balance first. You pay off the lowest balance because it feels really good, that motivates you, and then you continue paying. So I don't agree with him on everything, and that is perfectly fine. I think it's good to read other people's perspective. I think it's good to expose yourself to other perspectives, to test your own perspectives. And I'm happy to say, though, that like everything else in the book I felt great about. And one of the things I was looking for out of this book is for its conclusion to basically be like stick 80% of your money in an index fund and like 20% in a bond fund and be done with it. And that's exactly what he said. He said stick 80% of your money in the same thing that Mr. Money Mustache just talked about, that Vanguard Total Market Index Fund, VTSMX or VTSAX. And if you want a smoother ride with less return, then you can stick, say, 20% into a Vanguard Total Bond Market Index. And yeah, it's only 286 pages to learn that, guys. All right, well, that is it. I would encourage everyone listening to me right now to get the audiobook or the actual book, The Simple Path to Wealth, and read it, absorb it, internalize it as part of your personal financial training. I'm going to link to all these different blogs and videos and Mr. Money Mustache articles in the description. Hope you enjoy it. Hope you enjoyed this video number 101 of the 5-Year Club. Have a fabulous evening.